high-quality order blocks can be extremely risky and may result in significant losses. Order blocks, often overlooked by many, play a pivotal role in executing well-informed trading opportunities and are a cornerstone in the strategies of smart money traders. However, many traders struggle to identify valid and high-quality order blocks, putting their trades at risk. Today in this advanced episode, we are diving into various candlestick order block types, trading strategies and price actions associated with order blocks that you might encounter in the market. But that's not all. We'll break down the key criteria and rules that elevate an order block to a high probability trade. So traders, if that's something you're interested in, please give this video a thumbs up to show your support and subscribe to our channel if you are new. See you after intro. Welcome back, traders. So let's get started. Now let's dive deep into the details of the order blocks and see what is the exact definition of the order block. In the bearish scenario, order block refers to the zone corresponding to the last bullish candle before a sharp and substantial downward movement that generates a valid break of structure. Similarly, in the bullish scenario, it refers to the area corresponding to the last bearish candle before a sharp and substantial upside movement that forms a valid bullish break of structure. Now let's see what is the psychology behind these zones in the market. The theory behind considering these zones as potential reversal areas is based on the belief that they represent manipulation areas formed just before a significant market movement. Traders view these zones as areas where a large number of buy or sell orders have been executed. Therefore, by using these zones in our trading strategy, we can potentially take advantage of the high probability of price reversal and change in direction when it reaches these areas. Now let's proceed to the next topic and discuss how to identify a valid order block in terms of candlestick patterns and see the various scenarios that we might encounter in identifying candlestick-based order blocks on the chart. In a bullish scenario, a candlestick-based order block refers to the last selling candle before the price starts pushing upward drastically. This candle typically breaks below or effectively sweeps the liquidity of the lowest point of the previous candle. For example, in the bullish diagram, we identify this red candle as a valid order block. It serves as the last bearish candle before the price initiates a drastic upward movement, having taken out the lowest point of the previous bearish candle and effectively swept its liquidity. Similarly, in a bearish scenario, a candlestick-based order block refers to the last buying candle before the price starts pushing downside drastically. This candle typically breaks above or effectively sweeps the liquidity of the highest point of the previous candle. Now, let's move into essential criteria and rules that we need to consider to identify valid order blocks in the market and understand how we can use them to our advantage. It's crucial to note that to have a confirmed and valid order block, firstly, price must take out and sweep the liquidity above or below the previous candle to form a valid order block. Secondly, price must leave inefficiency behind and generate imbalance near the order block area. If there is no proper imbalance between the subsequent candles, then the identified order block cannot be considered valid. Rule number 3. It must be unmitigated. Order blocks are considered one-time use, meaning we focus on the trading opportunity when price first enters an order block. Once an order block has been mitigated, we do not consider it as an area of interest for future trading. Rule number 4. It emphasizes that a high-quality order block must lead to a break of structure or a change of character in the market. Break of structure and change of character are essential signals that indicate whether the market will continue in its initial direction or will experience a reversal. To solidify our understanding of order blocks, let's examine more examples. Consider a series of bullish candles as illustrated. As you can see, the market momentum was bearish until the price created this weak bullish candle just before starting to push upward with these three large green candles. This weak bullish candle reached its lowest point here, and additionally, it took out and effectively swept the liquidity below the previous candle. As mentioned earlier, without a proper imbalance in the subsequent candles that form after the order block, our identified order block cannot be considered valid. If we look at this three-candle sequence, we see that the upper wick of the first candle and the lower wick of the third candle Do not overlap the whole body of the middle candle. Here we have a gap between the candles, representing the imbalance. Since the criteria for a valid order block are met here, this candle represents a valid order block. If we look a bit higher, we see that once again, the price has created an upward drastic movement. This red candle represents the last bearish candle that had just been formed before the price started to push drastically to the upside. We can see that this bearish candle has taken out and effectively swept the liquidity below the previous bearish candle. Since the price has also created a proper gap between these three sequential candles, meeting all the criteria for identifying a valid order block, we can now consider this candle as a valid order block with the potential to reverse the price if it pulls back down and mitigates it. As you can see, this bearish candle here is the last bearish candle before the price formed another bullish movement. However, this candle does not represent a valid order block because it did not take out the previous candle's low. Let's examine more examples. Consider another series of candles as illustrated in the second diagram. Once again, we see that the price has taken the low of the previous candle, effectively sweeping liquidity below it with this bearish inverted hammer candle. Thus, we have a potential candidate for a valid order block. However, there is no noticeable imbalance among these three candles, and the order block is mitigated by the upper wick of the bullish candle.